All right, all right. Welcome everyone to the Valentine's version of Mortgage Note Deals of the Week. This is going to get romantic real quick. Light your candles, everybody. Get your chocolates out. Pour a nice glass of wine. Get comfy. We're going to get romantic here talking about mortgage notes. I'm your host, Cal Ewing, for those of you that don't know me. And although it says no deals of the week, so far it's been one of these a month. Don't want to get too crazy. So I'm going to try to get a new episode every month for any of you that are interested in note investing, want to see what real note deals look like. I'll be breaking down the numbers on various deals, either that I've completed already or that I'm looking at doing currently. And for Valentine's Day, I'm going to do something a little bit special. We are going to talk about the successful merger of one bank, one mortgage, and a loving relationship with an owner finance mortgage, and how I was able to blend two mortgages together to create a cash flowing deal in what we call a subject to deal. So it's a romantic story of two mortgages on one property. Yeah, I just thought it'd be cool to mix it up a little bit. This is going to be one deal we're going to talk about today. This is the first subject to deal I did. And for those of you that don't know what a subject to deal is, I'm going to go through and explain exactly what that means, because it's not very obvious by the name. What it means, how you can structure these deals and set them up, and what a real life subject to deal could look like. And in this case, I blanketed the subject to hot and heavy, hot and steamy under the blankets with a owner financed wrap mortgage and created a note. So what does that mean? I'm going to explain it right now, and I'm just going to go right in and share my screen. But first of all, I hope you guys, thanks again for joining me. I know it's Valentine's Day, so if you're not attending this live, I totally get it. Probably should be out with your honey, doing something for them. And as I've always said, you can always watch the replays. I send them out. So if you're needing to leave early or you want to watch it again, there will be a replay sent out to you for anyone that registered. And then also I'm going to have this up on YouTube in a while. And so you can check back and watch it again if you want to look at it again, if you have to miss it or step away a little bit early, which I understand it being Valentine's Day. But thanks for joining me tonight. All right, let's get hot and heavy. Okay, so I'm going to actually be sharing my screen, and this is from my website, calewing.com. I've got some case studies here on my website. So if you want to be able to look at this in greater detail, if you just go to calewing.com and then just go to investment, pretty sure that's what the tab is. Nope, strategy. There we go. If you go to the bottom, there's some case studies here, and I'm going to be talking about this one here, Templegate Drive in Houston, Texas. And as I mentioned, this is the first subject to deal and one of my first note deals I've ever done. And as I've been wholesaling properties down in Houston from here in Canada, in Calgary, Canada, for quite a few years, I was wholesaling quite a number of houses. And as I got to meet more people in the real estate investing industry, I kept hearing about how owner financing and this cool creative financing way of structuring a deal called subject to. And so what subject to is, it's where you can buy a property while keeping the seller's mortgage on the property. Okay, so you're buying the house or the property subject to the seller's mortgage staying there. Okay, and you can buy property subject to the liens that are still on the property, the mortgage that's on the property, whatever it might be. But in this case, subject to refers to you're buying a house and the seller's mortgage, the seller's financing that they have on the property currently, it's going to stay with the house. It's going to stay secured to that property, but you are now going to buy the house. You're going to be the new owner, but the seller's mortgage is going to be staying on the property, and you are now on the hook, unless you negotiate something with the seller, but you'd be now on the hook for making the mortgage payments on time every month. Okay. And so this particular deal, I was just reading the summary, and I think it's just like the first sentence there is incorrect. We actually bought this not from the bank. This was from a wholesaler. So I used to buy deals. I bought a few deals from wholesalers every now and again when I find a good deal. And this particular deal, the wholesaler actually negotiated this with the seller. And then we stepped in, they assigned the purchase agreement to me and my company, and then we ended up buying the house, okay? But this is how the deal was structured. So this house here in Houston was owned, I believe he's a doctor, and everyone expects doctors to be, super wealthy and have it on the ball, but there's a lot of doctors and dentists and things like that they may be very skilled in medicine or whatever their specialization is. But it doesn't necessarily mean that you're skilled financially, right? And sometimes doctors and engineers and professionals, they're so busy and focused on their careers that maybe they don't actually have their personal finances sorted out. And maybe that, I don't know, this gentleman here that owned this property, he was facing foreclosure. I do know that. And he was a few months behind on his mortgage. And in Texas, foreclosures happen really quickly. So you can foreclose in under 6 months in Texas. So he didn't have a lot of time. He was going to lose his house. And so he agreed to sell his home subject to his mortgage staying on the property. Okay, so he was going to leave and wipe his hands of this situation. But the only way to sell the house really and avoid a foreclosure was this method, this creative financing strategy or method. And the reason for that is because he didn't have enough equity. Like when you're a wholesaler or a real estate investor who's paying cash, it needs to make sense for you to pay cash, right? If you're going to pay cash for a house, there needs to be a significant amount of equity to be able to cover repairs and then make a profit again if you're going to resell it. Or the rental numbers have to make sense. So a lot of times, in order to pay cash, it needs to be at a pretty steep discount. And in this case, he owed too much on his mortgage, and so the price you'd need to pay cash was below what he owed to the bank. Okay, so he just couldn't do a cash deal with this. So really, the only option he had is either foreclosure, or we could buy the property, give him a little bit of money to move out, and we would get his mortgage payments caught up, and then keep making payments for the rest of the time we own the house. Okay. And so that's worked for him, and that's what we ended up doing. So his mortgage stayed on the house, but we got the deed. So he no longer owns the deed. He no longer has ownership of the property. So we bought the house. We now own the property, can use it however we want, okay? But his mortgage is still in his name. So we didn't actually assume the mortgage. We didn't go to his bank and say, we're transferring this mortgage to our company's name. We didn't do that. We kept the mortgage, and it's still to this day in his name, okay? And that's what subject to is. Now you're going to hear certain people say, well, you can't do a subject to because banks all have due on sale clauses in their mortgage documents, right? Their deed of trust or their mortgage document. And that's true. Almost every mortgage has a clause in there, due on sale, which means that if I have a mortgage with this bank and I sell the property, the lender has the right to call the mortgage due, meaning that you have to then pay the mortgage off. But they're not obligated to do that. They don't have to do that, number one. They have the right to do that. But most of the time, if you think from the bank's perspective, if they've got a mortgage and the borrower stops paying, they're now no longer getting income from the interest on that mortgage, right? And they're going to have to foreclose, which costs money and time. And then they're going to either sell off the property at the auction, or probably they're going to take that property back as an REO. And now they have to figure out what to do with it. And banks aren't in business to own properties. They don't want to own real estate. They don't want to own your house. They want to get interest payments from you. They want to lend out money and earn interest. And so they don't want to own your property. And so if you can come in and save the day with a motivated homeowner who's behind on their payments and get that mortgage paying again, that bank is not going to want to call that loan due. They want performing loans. They want borrowers that are paying regularly. So number one, we're going to get a non-paying mortgage back on track, paying again. So they're going to be happy. They're going to have no reason to look into this mortgage. When we're talking about huge banks that have thousands of loans, they're not going to be like looking at each individual mortgage and checking the deed. If you're paying on time, they have no reason to want to call the loan due, okay? So you don't really have to worry about that. And we didn't in this case. And Mr. Cooper, who's their current lender, which is Lakeview Loan Servicing. They go by Mr. Cooper for some weird reason. And we're going to go there in a second. They have not caused any trouble at all since we've owned this mortgage, and since we've owned this house, and it's been like 3 years. So they did not call the loan due. They did not investigate the fact that now my company owns the house. It's still in the seller's name to this day. Okay. So that's the background. All right. So we bought this house from this fellow for $202,000 plus closing costs. We paid all the closing costs for him because he wasn't going to get really any money at the end of the day. I cannot remember exactly how much behind he was, how many months behind on his payments, but I do remember that we, because this is like 2019, I think we bought this house. We did put some money in to get the mortgage payments caught up. Okay. And then we put some money into cleaning out the house. I'm pretty sure we ripped out the carpets and put new carpet in. Maybe not, but we definitely whitewashed all the walls. We painted everything. And the whole plan with this house was to owner finance it again to a new buyer and then create a new note and become the lender. Okay. So we wanted to get the house not remodeled, but just clean so that whoever wanted to buy this house didn't really show any signs of the old owner, and it was a nice clean property. And so that's what we put money in for. Okay. So we bought it for $202,000. Now that mortgage that we kept in place, the principal balance owing was $190,000, and that's what stayed on the property. Okay. They were behind in payments. So above that $190,000, we got it caught up. They were behind a few payments, but when we bought it, the principal balance was $190,000 once we got all the payments caught up. The value at the time was $230,000. So we bought it at a $30,000 discount, which is great. Okay. And then what we did, so at this point, when you own the house, you can do whatever you want now. We've got financing in place, so we didn't have to come to the table with $202,000 cash. Being a Canadian, it's hard for me to get a mortgage in the US because I'm not an American citizen. So I didn't have to go and try to find a loan to buy this house. The mortgage was already there and we just took over the payments. Okay. So out of nowhere, I was able to find financing, kept it in place, and we bought it at a $30,000 discount. Okay. So we could have done a full remodel and then sold it off like a fix and flip. We could have kept it as a rental and put a tenant in, could have done the Airbnb thing. But what we wanted to do, I say we, I actually had a funding partner that joined me in this deal. And so we joint ventured on this deal. And so what we ended up doing is owner financing it. So what we found, a borrower / buyer, someone that wanted to be a homeowner, but they were self-employed, number one. So they couldn't get a bank mortgage because they were fairly newly self-employed. We sold the house to a fellow that was a contractor. So he's very skilled in the trades. And then his wife owned a restaurant or taqueria, and she had her own business. So husband and wife were both self-employed, so they couldn't get financing. And so they had pretty good credit. Both of them had really good incomes, but they couldn't, achieve their dream of owning a house because they couldn't get financing as being newly self-employed. Okay. And that's the ideal kind of a borrower that we want. And so they came to the table. We sold them the property for basically $230,000. So the as is value, we sold it to them at market value. They came up with $20,000 down payment. And the cool thing about that is that covered almost all the cash that we put into this property to buy it. So at that point, we ended up having to pay the wholesaler their assignment fee. But other than that, that's all that we had in this property. So essentially, it was very close to a no money down deal at the end of the day, because we had to get the bank payments caught up, and then we had to clean up the property, and then we had some costs associated with marketing it to find a buyer. So we got most of that money back from the down payment we collected, and then we created a brand new note for $209,000 or $210,000, a brand new mortgage that new buyer now owes my company, 49th Parallel Properties, on this mortgage. So we created a brand new mortgage secured to this property, but the seller's mortgage was blanketed underneath. Okay, so the owner finance, this is why they call it a blanket or a wraparound. The owner finance mortgage that we created with this new buyer wrapped around the seller's mortgage, which is the underlying mortgage that's still in place. Okay, so what that means is the borrower buyer, the people that bought this house from us, they make a loan payment every month to us, to my company. I turn around, take that money, and I pay the seller's mortgage. And if you do it right, there's going to be a spread where you're getting monthly cash flow every month. Okay. And so in this case, I'm going to show you the actual mortgage statements here in a second, so you can see for yourself. But basically, we created a $456 a month cash flow and barely have any money in this deal, didn't have to get financing, barely had any cash in the deal. Okay, so we created a passive income solution here. We don't have to worry about tenants and toilets and broken light bulbs and vacancies and all those fun things that come with landlording, because we're just the bank, right? We only own the mortgage, but we're secured to this beautiful property in a housing market in Houston, which has been going up in value, and have no money in it. So it's a pretty awesome situation to be in. We have control and security to the property, but we're not responsible for the maintenance of the property. Okay. And the cool thing is, because the owner of this property, the guy that bought it from us, he's a contractor. In the first year, he did tons of work to the property, which was amazing. So now if we ever had to foreclose on this borrower for not paying, we're getting a house back that's even nicer than when we first started, because he did a bunch of renovations on the property. So that's awesome. Whenever you can get a borrower that renovates the property, that's even better for you as the note holder. Okay, so that's what we did. So we created a mortgage. First of all, let's look at the underlying mortgage, so the seller's mortgage. So this is with the bank is Lakeview Loan Servicing, and this is the statement. So when you buy a house subject to, you have to get access to the online banking from the seller, right? So we got access to his online banking just for the mortgage, and we don't have all his other banking, just the mortgage portal. And then we went in and changed the passwords, and so now we have full exclusive access to the bank mortgage website. Okay, we can make payments whenever we need, and we can check and make sure everything's good on the mortgage, right? We can see exactly what's going on. Okay, so in this case, the amount, well, this is the monthly payment that's due right now, but the principal and interest payment on the seller's mortgage that we are on the hook for every month is $965.01. Okay, and then this lender takes escrow payments as well, so they collect for property taxes and insurance. Okay, and we made sure that my company is on the insurance policy as a primary loss payee, and then my new buyer is also on the insurance policy, as is the seller. Okay, so all parties involved in this transaction are all covered under the insurance, which is good. Okay, and the great thing is this lender collects and pays all the taxes. So that's one less thing, again, that I have to worry about. They're making the insurance payments. They're paying the taxes, the property taxes every year. So I don't even have to worry about that. I just need to make sure that the payments are getting made. Okay, so in total, this would be the total monthly payment, but the principal and interest is $965. Okay, and you can see here right now, the seller's underlying mortgage, $171,000 is owed on that mortgage currently. Okay, and the maturity date is 2048. The interest rate is 4.375, which at the time was a bit high, but now that's a pretty sweet interest rate considering where we've been in the last year with rates. And so the original mortgage, I think, was from 2018, because it was a 30-year mortgage. So he'd only been paying on that mortgage for a year when he got behind, and then we bought the house from him. Okay, so he owes, or we owe, now that we bought the house subject to, $171,000. Okay, and each month we have to pay this mortgage in the amount of $965. Okay, so that's the underlying mortgage. Then This is the owner finance mortgage. So this is the people we sold it to who owe us a mortgage payment now, my company and my joint venture partner. You can see 49 parallel properties there. So Mr. Baca, he is paying 8% interest. So we have a difference in interest rate, which helps. Okay. And we sold it to him for 209, and he still owes 201. So he's paid about 8,000 of the mortgage. And so you can look at just the difference in loan balance, 201 versus 171. So there's a $30,000 difference there. So that the cool thing about that is if our buyer, the husband and wife that bought the house from us, if they decide tomorrow that they want to sell, maybe they're moving, they want to leave the city or something, if they or if they refinance with a different lender and pay us out, they have every right to do that, right? So they would owe us when they pay us out the 201, right? 201.40. So what we would do is then we would take that 201.40 and pay out the seller's loan of 171.4. Okay. And you can see then there would be a $30,000 profit that we've been waiting for the last 3 years. Okay. Because we sold it at a higher price and created a mortgage note for the new buyer that is $30,000 more than the underlying mortgage. And that's what you want to do with the subject to. Okay. So we've got equity built in there that someday we may capture. But now let's look at the payments. So as I said, we are paying $965 on the seller's mortgage. But Mr. Baca here, our buyer, is paying $1,540. And that is where, I already did the math once, this $456 a month spread comes from. Okay. So that's the cash flow. We're getting that much every month, but then there's that $30,000 equity spread as well that we could get if they ever pay us out. Okay. So that's a pretty sweet deal. Now, what do we do day to day on this? Well, this mortgage, this owner finance mortgage, and this note that we created is being managed by a loan servicing company. Okay. So we hire this company, and the cool thing is when we set up this mortgage with our new buyer, they actually pay the loan servicing cost every month. So I don't have that expense. And this loan servicing company, they handle all of the day-to-day management of this mortgage. So they send us a monthly report, making sure they show us how much our new buyer is paid. If they're late on the payment, they would show that. They would charge the late fee. They would let us know if they're very late and we need to foreclose. They send an annual report basically showing how much of principal has been paid down, how much interest has been paid. They reach out to the borrower. Just last week, the taxes and insurance went up because the city raised their taxes on that property. So they reached out and now they're charging more. So one thing I didn't mention is this new buyer borrower, they are paying the taxes and insurance as well. So I don't have to pay taxes and insurance either. Okay. And so they do it all. We don't have to do anything now that we set this deal up. We just sit back and collect that $546 a month, and it's great. No tenants, toilets, vacancies, any of that stuff. Okay. And then I just make sure I go in and make sure that they made their payment, and then I go in and make sure that our servicing company paid Mr. Cooper, so that we're not behind on the seller's mortgage. Okay. And that is the deal. It's pretty great. So don't know what more to say about that deal other than subject twos are a great way. I'm going to stop sharing here. Subject twos are a great way to buy properties if you don't have a lot of cash, or maybe you yourself, you've got too many mortgages right now, you've got too many rental properties, or for whatever reason you can't qualify for a mortgage. Well, using creative financing strategies like subject to can be a way of acquiring real estate by using the seller's mortgage and keeping it in place, which is really cool. And then you don't have to create a wraparound note like I did and owner finance it, but you could keep it as a rental. Like I said, you could do a rent to own in most states. So there's a lot of exit strategies once you have that property and that seller's mortgage in place. But what I like is the fact that this allowed me to create a note. And as I said, it's very low management. I don't have to worry and do, stress about anything. It's just a nice monthly cash flow coming in, and it's another stream of income. Okay. And so this deal right here, this and a couple others are what really got me interested in wanting to be a note investor, because being the bank and owning mortgage notes is just really, really hassle free. And it's just a great way of creating multiple streams of income. Okay. And the other great thing about being the bank is if our new buyer stop making payments, especially when you're buying notes in Texas or creating notes in Texas like we did, if they stop making payments, well, then you as the lender have the right to foreclose on them. Okay. It's not something we want to do, but that's always your right as the lender to foreclose and take the house back or sell it off at the foreclosure auction. Okay. One other thing I did fail to mention is if you are creating a note instead of buying a note, if you're creating an owner finance note like we did with our two buyers, you need to make sure that you run everything through a RMLO, resident. I think it's, excuse me, I believe it's Residential Mortgage Loan Originator. Might be wrong on what that acronym means, but RMLO, and what their job is, they're a third party. They would take the buyer's application and they would look at their credit score and their income and the terms of the mortgage, and they are going to make sure that that buyer borrower can afford that mortgage. And you as the lender, this protects you. It keeps you in line with all of the new Dodd-Frank rules that were in place after the well, basically shit hit the fan back in 2009 when there was, lenders basically giving away mortgages without even checking anyone's income. And that caused that whole wave of foreclosures that we saw, if you've ever seen The Big Short. So after that whole fiasco went down, they made some big rule changes to protect home buyers and borrowers. And so part of that is you need to make sure you're in compliance with these Dodd-Frank rules, and maybe individual states also have rules that you have to comply to. And so if you use a residential mortgage loan originator, RMLO, to make sure they vet your buyer borrower, make sure that they feel that they're basically signing or stamping saying that they guarantee that based on everything that was shown, your borrower can afford to buy that house. And then that way, as the note holder and lender, you're not on the hook for anything. You're not doing any predatory lending. You've done your work to make sure that they're in a house they can afford, basically, or in a loan they can afford. And then when you go to sell that loan, if you ever want to sell that note, you would provide all that package, the RMLO package, and that helps your new buyer, your note buyer, have confidence knowing that everything was done correctly. So everything's in compliance. Okay. So if you're thinking of doing any kind of owner financing, creating your own notes, doing subject to deals, I highly recommend, don't do it blind. Talk to a real estate attorney that specializes in these kinds of things. Reach out to me. I've got a great guy in Texas that will do subject tos and owner financing all over the country. So if you're looking for a good attorney that can do those kind of creative financing deals, I can definitely connect you there. All right. Did you guys feel the love? The love was in the air. I was trying to send the loving vibes through that one. But that's it. That concludes our subject to owner financing Valentine's Day edition. If you guys have any questions, feel free to either, if you're watching this on YouTube, watching the replay, post them in the comments and I will get back to every question. If you'd like to discuss owner financing, note investing, how you can get involved in some of these kinds of deals, reach out to me. You can either just post in the comments, or you can reach out to me and schedule a call at www.talkwithcalewing.com. And any questions, I'm happy to always give you my 2 cents. If you need connections, like I said, to that attorney or anything that I can do to help you in your note investing or your real estate investing journey, reach out to me if you got questions, and I can try and point you in the right direction. All right, everyone. Thanks for attending. And I know, again, it's Valentine's, so get back to your spouse, and I'll try to keep it short tonight. But thanks for watching, and I look forward to connecting you in the future or on the next episode of Note Deals of the Week. Take care. I'm Cal Ewing.